Sheena. We're on the last two objectives of chapter 2. I'm going to go ahead and tell you this video is going to be a little bit longer because we're going to walk through how to actually do the journal entries and then go through several practice transactions. It is vitally important that you have your notes with you, or at least a paper and pencil if you don't have access to a printer, so that you can practice writing down these journal entries. This is really one of the hardest parts of accounting, is really walking through this journal entry process. And so I want you to make sure that you have that and you're writing it down and you're going through these with me. You don't want to just sit and watch and listen to the videos. You won't capture as much as if you'll even pause the video, think through how to do it on your own after you've seen me do a couple, and then go back and play the video and see if you were right and check yourself. But really engage with the content as opposed to just being a passive observer is how you're really going to master this material. So we're going to first start by recording transactions in a journal and posting those to a ledger. So the first thing I want to mention is documentation, source documents. As accountants, it is very important that we always have a paper trail, and this is something that we'll talk about in Chapter 7 when we get to that audit function. But remember, all corporations have to be audited, and one of the things the auditors are going to do when they first visit is they're going to pull a random selection of transactions, and they're going to say, I want to see the paperwork that backs these up. So we've got to have some paperwork. So normally, we as accountants will do these transactions when the paperwork comes across our desk, and that's generally what spurs us. So we'll get a time card when it's time to pay payroll, or we'll get a purchase invoice when we've bought inventory, or we'll get a sales invoice or a receipt when we've sold a good or service. And that those invoices have all that paperwork, all that data on it that we need to do the transactions, and then we formally record those and save those so that we have them. So journalizing and posting transactions is a 5-step process. First of all, we're going to get some paperwork across our desk, and it's a transaction, and we're going to say, okay, what accounts are affected here? Remembering that there's always at least 2 accounts. There can be more, but there's at least 2. And what are those account types? Meaning, are they assets? Are they liabilities? Are they equities? Then we're going to apply the rules of debit and credit that aid readily to see whether the accounts are going up or down, and do they need to be debited or credited to make them go up or down. Keep in mind that every transaction has at least 1 debit and at least 1 credit, and they have to balance. Then we're going to write the transaction in the journal. Then the next step is to post the journal to the ledger or to the T accounts, and then double check that the equation is still in balance. So some rules when we are doing journal entries. Remember, all journal entries involve at least 1 debit and at least 1 credit. For us, mostly we're going to have just 1 of each for a while. We'll get to some more complex transactions later on. The debit account is always written first. The credit account, or the account to be credited, is written second, and it's indented. Okay, very important. So here we have a sample journal entry, and we can see, first of all, we have the date. Dates are very important in accounting. We'll talk more about that later, but very, very important that we have the date, and it's the date of the transaction, not necessarily the date we're recording it. We can see cash is listed first, and it's left aligned. So cash is the account that we are debiting. So we've listed the cash account, and then you'll see there's 2 columns. One says the debit and one says the credit. These are for the amounts. So since we are debiting cash for $30,000, we put $30,000 in the debit account. Now we see common stock is listed second, and notice that it's indented a little bit here. Let me highlight that a little bit. There's a little indentation here. That tells me that common stock is being credited, and then I've listed the credit amount in the second column. And then down at the bottom, this last thing that you see is just a explanation, a short explanation. So when you're doing your homework in my accounting lab, for the first few chapters, they'll make you put these explanations in here. Then they get to where they don't make you put them in there anymore. But I always say this is kind of like the memo line on your checks for those of us that are old enough to have ever written checks. So this is writing a journal entry. So now we've written the journal entry in the journal. And now the next step is to post that to the T accounts. So since I see that cash is listed first and it's left aligned, that means I'm going to go to the cash account, and on the debit side, I'm going to put 30,000. And since I see common stock is listed second and it's indented, I'm going to go to the common stock T account and put 30,000 on the credit side. So we're going to walk through several sample transactions here, and maybe you want to walk through one or two with me, but then I would encourage you to pause the video, try to do it yourself, and then start the video again so that you can check yourself. So the first transaction is that Sheena Bright gave us $30,000. Remember, we are always Smart Touch Learning. So Sheena Bright gave us $30,000, and we gave her common stock in return. So the first two accounts that would be affected would be cash and common stock. Now I encourage you, if you're writing this down, that to have Aid Reveille written across the top. So cash and common stock are two accounts affected. Whenever cash is involved, I like to start with cash. Cash is an asset. In this scenario, cash went up. We got $30,000, so cash went up. Since cash is an asset and assets have a normal debit balance, I want to debit the cash account for $30,000. So in your journal, and if you've printed off your notes page, you'll notice I give you sample, I made out little journals there for you to practice. You want to put November 1st, and on the first line you want to write cash. And then in the first column over there, you want to put $30,000. Now, here's the thing about journal entries is if you can figure out one of them, one of the two, the debits or the credits, then you know by default what the other has to be. So if I'm debiting cash, then I have to be crediting common stock. So I'm going to drop down the second line, I'm going to indent, and I'm going to put common stock. And then in the second column, the credit column, I'm going to write $30,000. Now, let's think through this for a minute. I know I said that cash went up, and cash is an asset, and assets are increased with a debit. Common stock, remember, is an equity account, and equity accounts have a normal credit balance. So if you remember from the LO2, Learning Objective 2 video, we said that common stock is always, 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 always credited. We never debit that account. We always credit it. So we know that it makes sense that we should be crediting common stock. So here we've got our journal entry. We've put our date of our transaction. We've listed cash first. It's left aligned. We've got 30,000 in the debit column. We've listed common stock second. It's indented. And we've got 30,000 in the credit column. So debits, I have a debit and a credit. Debits equal credits. I feel pretty good. And then I've put in my brief explanation. So you're going to be doing your homework in My Accounting Lab, and My Accounting Lab is really good about auto formatting some of this stuff for you. If this was a semester where we were in a real face-to-face class, and you were taking your test on campus, I would be making you handwrite these journal entries, and there's no auto formatting in the handwriting. And so depending on what your career goals are and what your educational goals are, you may have to go on to take some more accounting classes, and you may very well be required to write these journal entries. So I would strongly encourage you, as you're practicing, as you're doing your homework, to write out the journal entries. Even as you're doing your homework in My Accounting Lab, write out these journal entries, then put them into My Accounting Lab to check them, to input your answer, but practice writing them out. That's how you're going to learn them better. Now that we've got our journal entry, we need to post. So there in your notes, or maybe you want to grab a separate sheet of paper where you're going to write down all of these T accounts. You're going to make one T account, label it cash, and put 30,000 on the debit side, and then label another T account and call it common stock, and put 30,000 on the credit side. Now you don't want to use a new T account for every transaction. We have one T account, and we're going to put all of the cash entries in that one cash T account. So we're going to do a lot of entries that involve cash. You want cash to be a large T account. Common stock we're not going to do anything with, so that can be a smaller one. But the next transaction that we do that involves cash, you don't make a new T account. You keep rolling with that same T account. Okay. So again, you may want a separate sheet of paper to kind of put all your T accounts on. And so we verified that the equation, again, is still balanced here. So the second transaction we did, we purchased land and we paid $20,000 for it, $20,000 cash. So let's think through what accounts are affected: cash and land. So again, whenever cash is involved, I like to start with cash. So in this scenario, cash went down. We spent $20,000. So cash decreased. Now remember, cash is an asset, and assets have a normal debit balance. So to make cash go down, I want to credit the cash account. Well, if I'm crediting cash, that means I have to be debiting land. But let's think through this. Land, I own it, therefore it's an asset. Now, I have more land than I did before, so the land account should be going up. Land is an asset. Assets have a normal debit balance. So when I debit land, I will be increasing the land account. So this transaction involves only assets, but I'm debiting one asset, land, and I'm going to credit another asset, cash. So I'm increasing and decreasing assets by the same amount. So remember, we said we were going to debit land, so that's going to go on the top line, and it's left aligned, and then I put 20,000 in the debit column. And then I'm crediting cash because I'm spending it. I'm decreasing that account. So on the second line, I've indented a little bit, and I've put cash, and then I've credited it in the credit column for $20,000. Now remember, land is an asset. All assets are recorded at their historical cost. So regardless of what I think this land is worth, I have to record it at $20,000. Even if I think, oh, I got a really good deal on this, it's worth $25,000. I can't record it for that. I have to record it for $20,000. So now I'm going to post these to my T account. So here you can see I've used the same cash account, but I've got $20,000 now on the credit side. So you don't have to compute the balance, but if you wanted to, you could draw a single line and say, well, I have debits of 30 and credits of 20, so the balance would be 10 on the debit side. But again, you don't have to compute the balance after every transaction. Usually we only do that after a certain period of time. So you've got your cash T account just rolling on down there, and your land T account also has 20,000. And now again, I can check the equation, and it's all still in balance. Assets still equal 30,000, liabilities and equity still equal 30,000. So transaction 3, we bought office supplies on account. Remember, we talked about this in chapter 1. So on account means we did not pay cash for them. No cash was involved. In this case, since I was the buyer, this would be accounts payable. So remember, I'd gone to Office Depot, I'd gotten my $500 of office supplies. I said, hey, put this on my tab, send me a bill, I'll pay you at the end of the month in one fell swoop, okay? So my two accounts affected would be office supplies and accounts payable. Now, office supplies is an asset. I own these office supplies. It's an asset. Accounts payable, remember, is a liability. It's a debt. I owe Office Depot $500. So I have more office supplies than I did before. I need to increase the office supplies account. Since office supplies is an asset and assets have a normal debit balance, office supplies will get increased on the debit side. Accounts payable is a liability. Liabilities have a normal credit balance. I have more debt than I did before. I now owe them $500, so I need to increase my accounts payable with a credit. So my journal entry, I'm going to, on the top line, debit office supplies and put $500 on the debit side. And then I'm going to skip down the second line, indent a little bit, write accounts payable, and credit it for $500. Now I'm going to stop right here for a minute and address a question that I commonly get in class that says, isn't office supplies an expense? And the answer to that is not yet. I bought these office supplies and I put them in my supply closet. I own them. I'm expecting to use them. I'm expecting them to provide me with a future benefit. So they're an asset. Now, once I've used all these office supplies, they will become an expense because I've used them up. And an expense is an asset that we've used up. So in chapter 3, we're going to learn how to go in and say, oh, you know what? I've used up all these office supplies and I'm going to transfer those out of an asset into an expense. Okay. Now, the other question that I oftentimes get asked here is, how do we know that it's accounts payable and not accounts receivable? Because remember, we're going to use on account for both accounts payable and accounts receivable. And the thing is, you have to think of who you are in the transaction. In this case, since I'm the buyer, I'm the purchaser, I have to pay for these supplies, so it's going to be an account payable. In a little bit, when I'm the seller, I'm going to be receiving the money, it would be accounts receivable. So if you are purchasing something, it's accounts payable. That's an easy way to remember it. They both start with a P. And then I'm going to post these to those T accounts. So I'm going to debit the office supplies T account for $500 and credit accounts payable for $500. So transaction 4, sorry. So on November 8th, we collected cash of $5,500 for service revenue that we earned. So again, I want you to be thinking in the future, they're not always going to tell you it's service revenue. Sometimes they'll say you collected $5,500 by providing e-learning services. And you have to know, oh, wait, I provided services, I did work, that has to be revenue. So my two accounts affected would be cash and service revenue. Now remember, we said in learning objective 2 that revenue is always credited. So I just already know I need to credit service revenue. I did work, I'm going to credit revenue. So if I'm crediting revenue, then I have to be debiting cash. Remember, cash has a normal debit balance, so a debit increases the cash account. Well, if I just got a check for $5,500, then that should definitely increase cash. So that would make sense that I would debit cash and credit service revenue. So again, I'm going to write out that transaction on the first line where I have cash and then $5,500 in the debit column. And then I've indented a little bit, credited service revenue, and then put $5,500 in the credit column. And now I post this to these T accounts. So we can, again, we're carrying on with the same cash T account. And now I have a credit to service revenue of $5,500. So transaction 5, here we're told that we performed services for a client and we earned $3,000 of service revenue on account. There's that phrase on account again. But this time I'm the seller, not the buyer. This time I'm the one doing the work. So I did work for a customer and they said, hey, send me a bill, I'll pay you later. Okay. And I agreed to this, otherwise I would have said, no, you need to pay me up front, right? So I agreed to this. So service revenues affected. I did work, and I know that I always credit service revenue, so I'm going to credit service revenue for $3,000. But since I did not get cash, I'm not going to debit cash, I'm going to debit accounts receivable. Okay, I'm going to debit accounts receivable, which is an asset. And since assets have a normal debit balance, by debiting accounts receivable, I am increasing the accounts receivable account. I am expecting to receive $3,000 that I wasn't expecting to receive before. So I have an expected future benefit of $3,000 that I need to increase that account for. Now again, a good rule of thumb is accounts receivable and service revenue, they both start with an R there, go together. You will never have a transaction that has accounts payable and service revenue together. So if it's revenue, it's got to be the receivable account. Okay. In fact, the only two possible debits when you have a credit to service revenue, the only two possible debits are accounts receivable or cash. So either you got paid at the time you did service or they're going to pay you later. Okay. And then I've again posted to my T accounts where I've debited my asset account receivable and I've credited service revenue. So now I'm going to pay some expenses with cash. I'm paying office rent, I'm paying salaries, and I'm paying them with cash. So in this example, I'm going to have 3 accounts affected. I have cash affected, I have rent expense affected, and I have salary expense affected. Now remember, we said with expenses, we always debit expenses. Okay, so I know that I'm going to debit rent expense and salary expense, and then I'm going to credit. That means I have to credit cash. Remember, cash has a normal debit balance. So if I'm spending cash, that means I want to decrease it on the credit side. So this is what's called a compound transaction, where you have more than one debit or more than one credit. It is perfectly acceptable to have more than one debit or more than one credit, as long as all of the debits equal all of the credits. So the sum of the debits has to equal the sum of the credits. So you'll notice that I have 2 debits. I have rent expense and salary expense. They're both listed before the credits, and they're left aligned. It does not matter which order you list your debits in. You could have put salary expense first or rent expense first. That doesn't matter. What matters is that you have to have all of your debits first, and then all of your credits that are indented as we see cash is. So you could not have a debit to rent expense, a credit to cash, and then a debit to salary expense. That would be incorrect. So we have to have all of the debits together, all of the credits together, and the sum of the debits equals the sum of the credits. So we notice these two are both left aligned and cash is indented. So now when I post these, I have rent expense and salary expense are 2 separate accounts. So I have an account for rent expense and an account for salary expense that both get debited, and then I credit cash for the total. Okay. Now, the overall effect, remember, I've decreased the left side of the equation and I've decreased the right side of the equation, because as expenses increase, they decrease retained earnings, which decreases equity. So I hope by now that you're pausing the video when you see a new transaction come up, you're trying to work it yourself, and then you'll start the video to check yourself and listen to the explanation. If you haven't started doing that yet, start doing that now. So here we're told that we're paying $3,000 on the account payable from transaction 3. So that was when we bought the office supplies. So remember, we debited office supplies for $500 and we credited accounts payable for $500. Now we've gotten the bill from Office Depot and we're going to pay them $300 of the $500 that we owe. So my 2 accounts affected are going to be accounts payable and cash. Office supplies is not going to be affected here. I'm just paying for the office supplies that I've already bought, but I didn't get more office supplies. I don't have less office supplies. So office supplies is not affected. Okay. So accounts payable, if you remember, that's a liability. It has a normal credit balance. So if you look in your T accounts that you've drawn on your notes, you have accounts payable is sitting there with a $500 credit balance. I've now paid $300 on this. So in order to reduce this liability, I want to debit accounts payable. I want to debit accounts payable, and therefore I'm going to credit cash because I'm spending cash, and when I reduce cash, I credit it. So my journal entry is a debit to accounts payable, so it's listed first and left aligned. And then on the second line, I've indented and I've credited cash for $300. So now when I pull up my T accounts, I have a credit to cash for $300. I have a debit to accounts payable of $300. So if you wanted to calculate your new balance in accounts payable here, you would draw a single line to subtotal and say, well, my debits total $300, my credits total $500. So the difference is $200 on the credit side. All right, so in transaction 8, we are collecting on the account receivable. So back in transaction 5, remember we performed services for a customer and they said, hey, yeah, you can pay us later. So in that transaction, if you're looking back in your notes, you'll notice we debited accounts receivable and we credited service revenue. So now we've gotten a check from the customer for $2,000. So in this transaction, the accounts that are affected would be cash, because we got a check for $2,000, and accounts receivable. Revenue is not affected in this transaction because we've already recorded the revenue. We record revenue when we do the work. We didn't do any more work. We're just finally getting paid for the work we did earlier. So revenue is not going to be affected here. It's just cash and accounts receivable. So if you remember, originally we debited accounts receivable. So if you're looking in your notes at your accounts receivable T account and has a debit of $3,000, now the customer has paid me. So they owe me less money. So I want to credit accounts receivable. I'm going to credit the asset to reduce it. I'm going to show, hey, they owe me less money. So I'm going to credit accounts receivable. And I'm going to debit cash because I have $2,000 more in cash than I had before. So my journal entry is going to be a debit to cash of $2,000, so that's listed first. And then accounts receivable is credited. It's listed second and indented for $2,000. So now when I look at my T accounts, again, I've debited cash to show, hey, I have more money. If I look at my accounts receivable T account here, I had the debit for $3,000, and now I've credited it for $2,000. So now I can calculate the new balance and say, hey, look, they only owe me $1,000 now. Rally, a touchscreen would be so nice here. They owe me $1,000 now. So accounts receivable has a new balance of $1,000 in it. All right, so here's some new transactions. You may have noticed that all of those other transactions we did before back in chapter 1. Here's some new ones that we haven't done before. So here we're told on December 1st, we prepay 3 months of office rent for $3,000. So we wrote a check to our landlord for $3,000, and this is going to cover us for all of December, all of January, and all of February. So I don't have to pay rent again until March 1st, okay? So this is an asset. I'm expecting to receive a future benefit. I'm expecting to get to use this office for the next 3 months. The landlord can't come back in January and say, nope, you need to give me some more money. It's like, no, 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 I've prepaid you. I'm all good here. So I have an asset that I'm going to call prepaid expense or prepaid rent for $3,000. And so since I have this asset, I have this expected future benefit. Assets have a normal debit balance. I've got more prepaid rent now than I did before. I want to debit prepaid rent for $3,000. And because I wrote a check for $3,000, I'm going to credit cash for $3,000. So I've debited prepaid rent and I've credited cash for $3,000, keeping in mind that prepaid rent is an asset. So now as I post this, I have a new asset account called prepaid rent that has $3,000. Now in chapter 3, we're going to learn what we're going to do when, let's say, we get to January 1 and we say, well, we don't have $3,000 of prepaid rent anymore. We've used up a whole month now. So we're going to go in and adjust that account to make it correctly show that we only have 2 months of rent instead of 3 months of rent. But we'll do that in chapter 3. So here we're told that we paid some employee salaries of $1,200. So I need to pay this expense. So my 2 accounts would be salary expense and cash. Remember, we always debit an expense. So I'm going to debit salary expense and I'm going to credit cash because I spent $1,200. And I reduced cash with a credit, so I've debited salaries expense and credited cash. Notice again, my debits are always listed first, my credits are listed second and indented. And I've posted these now to my T accounts. So salaries expense already had a debit in it from November, and now I've debited it again. And I've got another credit going to cash here. Here we're told in transaction 11, we're purchasing a building with a note payable. So I didn't give them money. I have a debt. I owe them money for this. But I purchased a building for $60,000 and now I have a debt or a note or a mortgage, if you would prefer, on this building. Now, I own the building, so that's an asset. Assets have a normal debit balance, so since I have more buildings now than I did before, I want to debit the building account. Note payable is a liability. Liabilities have a normal credit balance. I have more debt now than I did before, so I need to increase my note payable account. So I'm going to debit building and credit note payable for $60,000. And then I'm going to post these to my T accounts. So on transaction 12, we got the electric bill, or excuse me, the telephone bill for $100. We're not going to pay that bill this month. We're going to pay it next month. It's not due till sometime in January. That's when I'm going to pay it. But I did get the bill, so I need to record that I now have this liability. I have this debt that has accrued. So I know that I have a liability. I'm probably going to call it utilities payable. Maybe telephone bill payable, but probably utilities payable. I have more debt now than I did before, so liabilities have a normal credit balance, so I'm going to increase credit the liability for $100. Now, usually a utility bill is an expense, so I'm also going to debit the utility expense account. Remember, expenses are always, always, always debited. So I'm going to go ahead and debit utilities expense and credit utilities payable. Now, next month when I pay the bill, I'll debit the utilities payable and credit cash to show that I paid it. But this is just getting the electric bill, and it's like, oh shoot, now I owe $100 to the telephone company. And so I'm going to post these to my T accounts also. So I have a credit to utilities payable, and then on the left side of the debit side of you debited utilities expense. So on December 21st, we're told that we agreed to provide some e-learning services to a customer, and they paid us $600 in advance. So they paid us up front. They gave us a check for $600, and we promised that sometime later we will come in and do these online trainings for their firm. So I got a check for $600. That's a debit to cash. Anytime I get a check, that's a debit to cash. I can't credit revenue yet because I have not done the work. I haven't provided the training services. I've just promised that I would. So I actually now owe them training services. So this is that liability account unearned revenue that we talked about earlier. Remember, unearned revenue is a liability, so it has a normal credit balance. Since I now owe this customer more training services, I need to increase my liability. So I'm going to debit cash to increase my cash account because I got a check, and I'm going to credit unearned revenue to increase the liability account. And you may want to write in your notes, hey, some students like to kind of put little parentheses and say maybe that's an L, that's a liability account, to kind of remind you that that's a debt liability account. And then again, I'm going to post these to my T accounts. All right, so now that we've done several of the transactions, we're going to do the next step, once we've kind of done all of our daily transactions, is to prepare what's called a trial balance. Now, a trial balance is not a financial statement. If you went and looked at some of those annual reports that we talked about at the end of chapter 1, you'll notice you didn't see a trial balance in them. It's not a financial statement. It's an internal only schedule, if you will. Really, all it is a list of all of our accounts and what their balances are at that point in time. So we would go list all of our accounts out. Typically, you list them in order: assets, then liabilities, then equity. You list their balance and whether it's on the debit or the credit side, and we total them up. We're checking to make sure that debits equal credits. If we total this up and we don't find that debits don't equal credits, we know that we've made a mistake somewhere, and we got to go back and fix it. Because if debits don't equal credits, nothing's ever going to work out, right? So this is a checkpoint kind of along the way to say, like, okay, debits equal credits, I can move on to the next one. If they don't equal, then we know we have to go back and find our mistake. So this is where we're going to stop in this particular chapter, and in chapter 3 we're going to pick up with this trial balance and then finish out the end of the year.